Hey everyone, and welcome to The Explainer. Okay, let's just dive right into it. Today, we are taking a really close look at one of the absolute heavyweights in American banking, Wells Fargo, ticker symbol WFC. Our goal here is totally objective. We're doing a structured, data-driven analysis to answer one specific question. Is this banking giant a genuine buying opportunity right now, or is it kind of running out of steam? We're going to look at the numbers, the news, and the charts to give you the full picture.
To build our thesis, we're going to break the whole thing down into 5 quick parts. WFC by the numbers, recent news and catalysts, checking the financial health, technicals and analyst sentiment, and finally, we'll weigh it all out with an impartial bull versus bear verdict. So, let's get started.
All right, Section 1, WFC by the numbers.
Let's anchor ourselves with a quick snapshot from the August 14th, 2026 market close. The stock finished the day at exactly $88.82. Now notice that 52-week range. Sitting right between 72 and 97 bucks, this actually puts Wells Fargo near the upper end of its yearly range, but it's still about 9% below its peak. It's a really interesting setup for us to evaluate.
And at that share price, their total market capitalization comes out to a massive $264 billion. But for you value-focused investors out there, here is the kicker. Wells Fargo is trading at a price-to-earnings ratio of just under 13 times forward earnings. Basically, compared to the broader market, you really aren't overpaying for their future profits here.
Oh, and for the income investors, you're going to want to look at this 2.28% dividend yield. It stems from a recently raised quarterly payout of 50 cents a share, and honestly, it remains highly competitive, making it a super attractive element for anyone looking to build up an income-focused portfolio.
Moving right along to Section 2, recent news and catalysts.
Now, to really understand the why now, we have to talk about their recent comeback story, because it's a big one. The biggest weight off their shoulders came back in March 2026, when the Federal Reserve officially terminated its enforcement action from that old fake account scandal. With that dark chapter finally closed, management pivoted 100% to growth. Then, in late May, we got this strong CEO guidance pointing to mid-teen growth in investment banking. And that all culminated in an absolute blowout second quarter earnings report on July 14th.
Just look at the massive gap between expectations and reality on July 14th. Wall Street analysts had anticipated an earnings per share of $1.72, but instead, Wells Fargo posted an incredibly strong $2 flat per share. I mean, they crushed the consensus by a very wide margin.
And crucially, this beat wasn't just fueled by plain vanilla retail lending. No, it was driven by a massive surge in high-margin investment banking and trading. Investment banking fees jumped 35%, nearly $1 billion. Markets revenue expanded 24%, while equities trading spiked an incredible 64%. This is huge because it shows Wells Fargo is successfully transforming its business model and competing directly with heavyweight capital market players like JP Morgan and Goldman Sachs.
On top of that operational shift, CEO Charlie Scharf actually addressed the industry-wide pressure on net interest margins head-on. He stated that margins should stabilize after the third quarter. For anyone holding this stock, that is exactly the kind of transparent, forward-looking reassurance you want to hear from leadership. All right, on to Section 3, checking the financial health. Looking under the hood here, their top and bottom line expansion is just incredibly solid. Total revenue hit $22.62 billion. That is up 8.6% year over year. But even better, net income surged 17% to over $6.4 billion. Listen, generating this kind of revenue growth in a high interest rate environment where a lot of other banks are just struggling to maintain their loan books, it's a massive testament to their recent execution. Beyond the pure revenue growth, the bank's efficiency ratio, which basically measures how much it costs to generate a dollar of revenue, is improving, mostly thanks to aggressive cost-cutting and branch closures. Plus, their Common Equity Tier 1 capital, which is essentially a bank's rainy day fund, remains well above regulatory minimums. Simply put, they have built a very thick financial cushion against any unexpected economic shocks. However, keeping things completely objective here, we do have to address the elephant in the room: commercial real estate. Now, while they haven't seen a massive spike in defaults yet, Wells Fargo, like the rest of the industry, has had to set aside slightly more capital for potential loan losses in the commercial real estate sector. It's a macroeconomic issue affecting the entire banking sector right now, but it's absolutely a risk factor we need to watch carefully going forward.
Moving into Section 4, technicals and analyst sentiment. Let's see what the charts are saying.
So, Deciphering the technicals, the trend is broadly bullish. The stock is trading above its key moving averages, and momentum indicators like the MACD are flashing green. But pay really close attention to that bottom row. The ADX reading is sitting above 75. In plain English, this is a yellow flag. It's warning us that the recent rally might be overextended in the short term, so we could totally see a pullback or some consolidation before the stock moves any higher.
When we look at what the pros are saying, analysts broadly agree with the bullish momentum. Across more than 20 firms, the consensus rating is a moderate buy with an average price target of $98.60. That implies an 11% upside from current levels. And Jefferies actually holds the highest target on the street right now at $109. Now, this data point is absolutely fascinating to me. Just yesterday, over 59,000 new call options were opened, betting the stock hits $100 by December. Activity of this magnitude, that doesn't just come from everyday retail traders. No, this is serious, smart money institutions placing a massive, bullish bet that Wells Fargo is going to hit a triple-digit stock price before the end of the year.
And further backing up that confidence is the ownership footprint. Check this out. The smart money currently holds 76% of the stock. That is a massive institutional commitment for a large-cap bank. It shows that despite some minor selling from smaller firms, the big money remains deeply, deeply invested in this Wells Fargo turnaround story. Which brings us to our final part. Section 5, the bull versus bear verdict.
Let's weigh the facts side by side. On the bull side, you have a newly transformed bank with a clean regulatory slate, fantastic earnings momentum and high-margin businesses, and it's trading below its 52-week high with a very competitive 2.3% dividend yield. But flip it over to the bear side, and you can't ignore the short-term overbought technicals. That tells us a pullback could happen soon, especially when you factor in those looming macroeconomic risks like potential commercial real estate defaults.
Which leaves us with this final thought for you to consider, based entirely on your own personal risk tolerance. Is this newly liberated banking powerhouse a long-term portfolio staple with plenty of room to run? Or do the short-term technicals and economic unknowns keep you on the sidelines, just waiting for a better entry point? That's all for today's Explainer. Use this data to inform your own strategy, and I can't wait to explore our next topic with you soon.